Hello, my name is Devin Villa, and in this presentation, I will cover three essential financial concepts: the goals and functions of financial management, the steps in conducting a sensitivity analysis, and the methods used to evaluate risk within a capital budgeting analysis. Let's get started. The primary goal of financial management is to maximize shareholder wealth, which is reflected through the company's stock price. How is this achieved? By making strategic financial decisions. These decisions consist of a detailed analysis of resource allocation to produce the most significant profit, understanding how to finance projects, efficiently managing day-to-day operations, and proper management of financial risk to ensure sufficient liquidity to meet long-term and short-term obligations. These functions help the company remain financially healthy and competitive. Sensitivity analysis is a what-if technique used in capital budgeting to assess which inputs matter most and how outcomes change when assumptions vary. Put another way, a company may use a sensitivity analysis to understand the impact and influence market variables such as interest rates have on a dependent variable such as return on investment. Typically, it helps financial managers understand how sensitive a project's net present value, or NPV, or internal rate of return, or IRR, is to changes in key market factors such as sales volume, costs, or the discount rate. For example, a company might conduct a sensitivity analysis to see how changes in the interest rates affect a specific bond. This enables decision makers to pinpoint which assumptions have the most significant impact on a project's success. Sensitivity analysis begins by identifying key financial variables such as sales, costs, and the discount rate. Then, it models how changes in each one impact the NPV or IRR. We begin with a base case scenario and adjust one input, such as product cost or market demand, at a time to see which variables the project is most sensitive to. This highlights where risk is concentrated and helps guide contingency planning. However, we must also consider qualitative risks, such as management strength, regulatory changes, competition, or emerging technologies, which aren't easily modeled but can significantly affect outcomes. A comprehensive analysis integrates both quantitative data and qualitative insights to better inform capital budgeting decisions. When companies are deciding whether to invest in a new project, they often use a few standard internal methods to assess the risks involved. We've already looked at scenario and sensitivity analysis, which help predict how changes in key assumptions might affect the project's outcome. Another method is a break-even analysis, which shows the minimum level of performance required for a project to break even and avoid losing money. The third approach is to use a risk-adjusted discount rate, which means adding a bit of extra caution, or a risk premium, to the rate used to evaluate future cash flows to account for uncertainty and potential fluctuations. External financial risk methods look at factors outside the company that could affect the project's success. This may involve comparing your project to how others in the industry are performing, keeping an eye on broader trends such as changes in interest rates, inflation, or the overall economy, and utilizing insights from external experts, including rating agencies or consultants. Taking these external factors into account helps ensure that your investment decisions reflect the broader picture, not just what's happening within your own company. Thank you for watching my presentation. I hope these tools are both insightful and useful. These are the sources I referenced while preparing this material. Please let me know if you have any questions or would like further clarification on any of the topics discussed. Thank you.